I often get asked the question whether people should enter into the market at this time. They're fearful that we're in a housing bubble. So I want to answer that question today. Are we in a housing market bubble? Hi, I'm David Pastana, broker owner of Rise Realty, where we help you succeed in real estate. Thanks for watching this episode of our video blog. We'd love to hear from you. Please like, comment, and subscribe to our page. We'd appreciate the support. So I want to answer the question, are we in a housing market bubble? So what is a housing market bubble? Housing market bubble happens when too many speculators enter the market. They're not necessarily interested in housing, they're just looking to make a buck. And so as homes appreciate, as they are making people money, what happens is investors enter the market. Homeowners jump in because they're fearful that if they don't, they're gonna have to pay more for the house than they would a year from now. So too many people start entering the market on what we call speculation, and it passes what we call an affordability index. Housing affordability index measures whether or not a typical family earns enough income to qualify for a mortgage loan on a typical home at the national level based on the most recent price and income data. Basically, a value of 100 means a family earning the median income earns enough to qualify for a mortgage on a medium priced home at the time. Anything above 100 means the family has more than enough to qualify. The higher the score, the easier it is. So let me put this into normal words. If people can still afford the homes that are for sale, we are not in a bubble because the homes aren't exceeding people's affordability yet. If numbers are above 100, that means the average person can definitely afford the house. The higher the number, the more affordable. So back in 2009, the number was 169. From 2009 to 2012, the affordability was going up. Why? Because the housing market was crashing for those years. And so the housing prices were going down, making homes more affordable for the average person. Starting in 2013, home prices started to rise dramatically, really at a rate of 5 to 6% here in Utah. Our affordability went down from 197 to 176, then 164, leveled off 2014, 2015, and today it's at 153. So our affordability is definitely going down as prices go up. But I want to show you another image which is going to put this into perspective. Let's go bigger picture on what's happening. In this image, the housing affordability index is now measured from 1990 till today. That's like 35 years of data here. The grayed out area is the area that I just showed you, and the blue on the right, that's today's affordability index. So if we take that and you put a line all the way across and you put affordability over the last 35 years, you can see again, the higher the bar, the more affordable the homes. So on a 35-year big picture, housing's still very affordable. We wouldn't be described as being in a housing bubble because our affordability is still much, much higher. Again, once you reach below 100, that's when homes are starting to get too expensive for the average consumer. Now, I can't talk about this subject of a bubble without talking about credit. Credit is so important in getting a house. In the last crash, it was really precipitated by a credit bubble. Credit bubbles are when, I would say basically the banks are giving loans to people who really shouldn't have them, that don't have the ability to afford them. I remember loans that people were doing, they were called the no income, no asset loans, and they often had bad credit. So that means they wouldn't verify your income, your employment. You basically just fill out a sheet saying, yeah, I'm employed, I'm self-employed, and I make $250,000 a year, and I have $50,000 in the bank. They pull your credit, you have a 700 credit score, and they say, okay, and they would just give you a loan without validating that. What happened is they were giving loans to way too many people who couldn't really afford them. And when the market turned, they didn't have a high motivation to pay them, or they absolutely lied and they really didn't have the money to do it. They were just speculating on the market. So Let's look at credit availability. I want to show you a graph here of the historic data for Mortgage Credit Availability Index. The higher this is, the more credit was available. And you'll see this is from June 2004 through 2007. You see this huge spike. That means that the credit was very easy to get. They were giving loans to everybody. And people weren't questioning that because they were just happy to get a loan, and I understand that. But it wasn't sound business practices. And so what happened in 2008, really 2006, 2007, banks were starting to collapse under this credit bubble because of all these people that shouldn't have had loans. It became too burdensome for the bank as their defaults started to increase. And so what you see in this graph is a tightening of credit as the banks started to go out of business. So literally, like by 2009, we had hundreds and hundreds of banks in the United States go under because they couldn't pay, they couldn't absorb all these foreclosures. And then it dropped the housing prices and it became the second largest crash in United States history. So today, how is credit availability? Well, it is historically now much, much tighter than it used to be. Today, everyone that I know that's getting a loan, it has to prove their income. We call that full documentation. You have to prove you have a job, you have seasoning or time in your job, and you have enough money to afford this house, okay? Those are big differences. Today, if you have less than a 620 credit score, you don't get a loan. Before, if you had under 620, that was called a subprime loan. So now, you can only get a loan really if you're 620 and above. That's under most FHA guidelines. And really, they want you to have good credit, which in most cases defined as over 720. So let me go back to the original question. Are we in a housing bubble? Should I get in the market now? No, we are not in a housing bubble. The data indicates that housing is still very affordable. It isn't affordable as it was 3 years ago, but it still is affordable. We are increasing in value. So should someone enter the market? I would say yes, because you're going to take advantage of all the appreciation that's going to happen. You can gain instant equity into your homes. Now you're going to have good credit, which is great because it helps stabilize the market by having real buyers come into the market. Housing is still affordable when you look at a long-term perspective. Although it's harder to get loans, it makes it so that people that are getting loans are highly qualified buyers that are motivated to get into the market and that can afford the house that they're buying. The housing market's still going to go up. Everything indicates that we're still going to see a lot of appreciation in the market. So the key is you don't want to miss out on that appreciation and pay more for the same house a year from now or 2 years from now. We want to help you succeed in real estate. And we encourage you to search our site for all the homes that are out there. We can put you on listing alerts, and we can consult you to make sure that you never overpay for a property. We're here to help you succeed in real estate. Thank you for watching this video. Please like, subscribe, or comment. We'd love to hear from you.